Today is Saturday, August 16th, 2025. This is Patrick Brenner, president of the Southwest Public Policy Institute, and your host of SPPI-TV with a bulletin update on the state of consumer finance regulation in America. The big story today, the Consumer Financial Protection Bureau is cutting staff. That may sound like a retreat in federal enforcement, but the reality is far more concerning. Fewer federal regulators does not mean less regulation. It means something worse: the rise of 50 state-level regulators, each racing to fill the vacuum. The scope of this regulatory expansion is remarkable, with 16 states implementing new consumer finance statutes in just the past year. These changes represent fundamental shifts in financial oversight, expanding definitions of junk fees, creating new disclosure requirements, and introducing liability frameworks modeled after the CFPB's unfair, deceptive, or abusive acts or practices structure. This state-level surge in regulation creates a complex web of compliance requirements that financial institutions must navigate. The diversity of state approaches illustrates the growing complexity. New York's Fair Business Practices Act has dramatically expanded its Attorney General's authority, moving beyond traditional deception cases into broader interpretations of unfairness. Illinois has implemented comprehensive all-in pricing requirements, adding significant compliance burdens for lenders and service providers. Texas has tightened its grip on small business finance regulations. When federal courts invalidated the CFPB's medical debt reporting rule this spring, states like Colorado and California swiftly enacted their own restrictions on medical debt credit reporting. This regulatory fragmentation has created a puzzling landscape where financial practices face dramatically different treatment across state lines. A practice deemed legal in Texas might be prohibited in New York and subject to entirely different rules in Illinois. Payment platforms face varying obligations regarding scam reimbursement depending on their location. The recent lawsuit by New York's Attorney General against Early Warning Services, Zell's parent company, over fraud prevention practices demonstrates how product design decisions themselves have become enforcement targets. The impact on financial institutions is substantial and multifaceted. Banks and fintech companies must now develop multiple versions of the same products to comply with different state requirements. Some may choose to withdraw entirely from more restrictive markets, reducing competition and consumer choice. This fragmentation inevitably increases operational costs, which are typically passed on to consumers through higher fees or reduced services. The current situation presents a striking irony. While industry leaders previously criticized the CFPB's broad authority and aggressive enforcement approach, they now face an even more challenging environment with 50 different regulatory frameworks. The shift from one federal regulator to numerous state-level enforcers has created a more complex and costly compliance landscape as each state pursues its own interpretation of consumer protection standards. The Southwest Public Policy Institute had anticipated these complications, drawing parallels to our earlier warnings about state-level price controls on credit card swipe fees. Our analysis correctly predicted how such measures would increase consumer costs and negatively impact reward programs, a pattern now emerging across the entire financial services sector. The solution requires congressional intervention to establish a coherent national framework. This framework should focus specifically on transparency, fraud prevention, and measurable consumer outcomes. It should include federal safe harbors for firms that implement auditable best practices and preempt conflicting state laws to maintain healthy competition and innovation in the financial sector. Without congressional action to restore regulatory order, this fragmentation threatens to create lasting negative impacts on the financial services industry and consumers alike. The current trajectory suggests higher costs, reduced competition, and slower innovation, ultimately affecting every American household's financial options and costs. This situation represents a concerning reversal of the American principle. Out of many, one. Instead, creating many regulatory frameworks from what was once a unified approach. The financial services industry, and by extension American consumers, will continue to bear the burden of this regulatory fragmentation until a more coherent national framework is established. You can find out more about our work at southwestpolicy.com. I'm Patrick Brenner with the Southwest Public Policy Institute. Thanks for listening.